In 1968, the London Gold Pool, a consortium of 8 central banks, attempted to defend the $35 per ounce gold price by selling from their reserves whenever demand threatened to push prices higher. For 7 years, this worked. Then, in March 1968, they sold over 1,000 metric tons in a single month, nearly 40% of annual global production. And the pool collapsed anyway. The strategy of suppressing prices through reserve sales had become the mechanism of their own depletion. Today, in late 2025, bullion banks that have sold silver short on COMEX, contracts promising future delivery they don't physically possess, face a condition they cannot arbitrage away. Spot silver in London trades at premiums above futures, registered inventories have fallen 90% in 5 years, and the cost to borrow physical silver for delivery has exceeded 12% annually, higher than most corporate junk bonds. When the institutions that profit from the gap between paper and physical pricing find that gap has inverted against them, and the metal they've promised to deliver costs more to borrow than the profit from selling it, what does that signal about how much time remains before the system they've built unravels? For most of financial history, arbitrage was the mechanism that kept prices honest across markets in time. If gold traded at different prices in London and Amsterdam, merchants would buy where it was cheap, ship it where it was expensive, and profit from the difference. This activity, arbitrage, ensured that prices converged within the bounds of transportation costs and time delays. The mechanism was self-correcting and required no central authority to enforce. Arbitrage worked because the commodity being traded was physical. You could not arbitrage something that did not exist. If you bought gold in London to sell in Amsterdam, you had to possess the actual metal, arrange transport, ensure the shipment, and deliver physical bars to the buyer. The friction of physical reality constrained what was possible. You could not sell more gold than you could acquire and deliver. This constraint created market discipline. If a merchant promised to deliver gold he did not possess, he faced ruin when the delivery date arrived and he could not fulfill the contract. Reputation and commercial survival depended on honoring commitments. The system policed itself through the threat of failure and the opportunity for profit through legitimate arbitrage. The silver market operated under the same principles for centuries. The Spanish Empire, which controlled the largest silver mines in the Americas during the 16th and 17th centuries, shipped millions of ounces across the Atlantic to Europe and onward to Asia. Chinese demand for silver, driven by China's silver-based monetary system, created persistent premiums in Asian markets. Spanish and European merchants profited by buying silver in the Americas or Europe and selling it in China, earning the geographic price differential. This arbitrage was constrained by the physical realities of oceanic shipping. A voyage from Acapulco to Manila took months. Ships could be lost to storms or pirates. But the physical nature of the trade meant that arbitrage profits reflected real value creation, moving metal from where it was abundant to where it was scarce, reducing price differentials through actual supply relocation. The Bank of Amsterdam, established in 1609, formalized this principle through the creation of bank money backed by deposits of precious metals. Merchants could deposit gold or silver and receive bank credit that could be used for payments or transferred to other parties. The bank promised that credits were backed by actual metal in vaults and could be redeemed on demand. This created a form of paper money, but one strictly limited by physical reserves. The system worked for over 150 years because the Bank of Amsterdam maintained discipline. Credits issued did not significantly exceed metal reserves. When redemption demands increased, the bank could deliver metal. The connection between paper and physical remained credible. But in the late 18th century, the bank began lending against its reserves, creating more credits than metal backing. When this became known, redemption demands surged, and the bank collapsed in 1791. The lesson was clear. Paper claims on metal must remain tethered to physical availability, or confidence evaporates. The 19th century London banking system refined this model, but introduced a critical innovation: fractional reserve banking. Banks discovered they could issue more paper claims than they held in metal reserves because not all depositors demanded redemption simultaneously. As long as redemptions remained below a certain threshold, banks could operate profitably with reserves representing only 10 to 20% of outstanding claims. This worked during normal times, but created vulnerability during panics. If depositors lost confidence and demanded redemptions en masse, banks could not deliver and would fail. Bank runs became a recurring feature of 19th century finance. The solution was the creation of central banks, lenders of last resort that could provide liquidity during panics, preventing solvent banks from failing due to temporary redemption pressures. But this solution introduced a new dynamic: moral hazard. If banks knew they would be rescued during panics, they had incentive to take greater risks, issuing more claims relative to reserves, knowing that losses would be socialized through central bank intervention. The discipline imposed by physical metal constraints was weakened by the backstop of fiat currency creation. By the early 20th century, the system had evolved to the point where gold served primarily as reserves backing national currencies, rather than circulating as money. Arbitrage still functioned. If the dollar traded at a discount to gold parity, arbitrageurs would exchange dollars for gold, shipping metal to equalize prices. But the arbitrage was increasingly conducted by banks and governments rather than merchants. The physical constraints were loosening as paper claims grew relative to metal backing. The modern silver market is a structure where banks can profit by selling metal they do not possess, emerged through a series of regulatory and institutional changes that seemed incremental but cumulatively transformed how the market functions. The crucial shift began in the 1970s following the collapse of the Bretton Woods system and the end of silver's role in U.S. coinage. With silver no longer serving monetary functions officially, it was reclassified as an industrial commodity. This reclassification allowed futures markets to develop trading structures similar to agricultural commodities, where cash settlement and leveraged speculation were normal. COMEX, the primary U.S. silver futures exchange, formalized contracts that allowed participants to take either physical delivery or cash settlement. Initially, physical delivery was the norm. Futures contracts were genuine commitments to deliver or receive metal. But over time, the default shifted. Cash settlement became standard unless participants specifically opted for delivery. This inversion was subtle but critical. Once cash settlement became the norm, participants could sell contracts without possessing metal, knowing they would settle in cash at contract expiration. This created the possibility of naked short selling futures contracts, representing metal that does not exist in the seller's possession or even in readily available supply. As long as buyers accepted cash settlement, the short seller could profit from price declines or volatility without ever needing to acquire physical metal. Banks entered this market as intermediaries and market makers. They facilitated trades between buyers and sellers, earning spreads and commissions. But they also took proprietary positions, betting on price movements using their own capital. The combination created conflicts of interest and incentives to suppress prices through large short positions that would profit if silver prices fell or remained stagnant. The regulatory environment permitted this because futures markets were deemed to serve legitimate hedging purposes. Miners could sell forward production to lock in prices. Manufacturers could buy futures to secure future supply. Speculators provided liquidity. The system appeared to function efficiently, allowing risk transfer and price discovery. But it also allowed the accumulation of short positions vastly exceeding physical supply available for delivery. By the 1990s and 2000s, investigations and lawsuits alleged that banks, particularly large bullion banks with positions in both physical and paper silver markets, were manipulating prices through concentrated short selling. The banks denied wrongdoing, but several paid substantial settlements in civil cases without admitting fault. The pattern suggested that even if outright manipulation was not proven, the structure of the market allowed outsized influence by a small number of participants. The London Bullion Market Association, LBMA, operates parallel to COMEX but with even less transparency. LBMA facilitates over-the-counter silver trading primarily through unallocated accounts, bank liabilities, where customers own claims on silver but not specific bars. Banks can lend, lease, and hypothecate this metal multiple times, creating a complex web of claims that far exceed physical backing. The key mechanism through which banks profit is the lease market. Banks borrow physical silver from holders, mines, central banks in some historical periods, or large investors, at low lease rates, typically 1 to 2% annually. They then sell this borrowed metal on the spot market, receiving cash. They use the cash to invest in higher-yielding assets or to facilitate other trading activities. When the lease matures, they must return the metal. If silver prices have fallen, they can buy back metal cheaply and profit from the decline. If prices have risen, they must buy back at higher prices, potentially incurring losses. This strategy, borrowing metal at low rates, selling it, investing the proceeds at higher rates, and hoping to buy back cheaper, is profitable in declining or stable markets. It is disastrous in rising markets, especially if lease rates surge because metal becomes difficult to borrow. The strategy depends on two assumptions: that silver will not rise sharply, and that physical metal will remain available to borrow and repurchase as needed. For decades, these assumptions held. Silver prices remained range-bound between $5 and $20 per ounce from the late 1980s through the early 2000s, with brief spikes. Lease rates stayed low. Physical supply from mines and recycling exceeded demand. Banks could roll over leases indefinitely, profiting from the interest rate differential without ever truly covering their short positions by buying back metal. But the structure contained a latent vulnerability. If physical supply tightened significantly, if lease rates surged, or if prices rose sharply and sustained the rise, the arbitrage would invert. Instead of profiting from borrowing cheap and investing the proceeds, banks would face escalating costs to maintain short positions. They would need to pay high lease rates to borrow scarce metal or buy back physical silver at elevated prices to close positions. The strategy that had been profitable for decades would become a trap. The shift from profitable arbitrage to trapped position occurs when three conditions converge. Physical inventories deplete to levels where new leasing is difficult. Spot prices rise above futures prices. Backwardation, making the usual cash and carry arbitrage unprofitable. And industrial or investment demand for physical metal exceeds available supply, regardless of price. When all three occur simultaneously, banks that have sold short cannot easily exit positions without driving prices higher, validating the very price rise they were betting against. This is the condition emerging in late 2025. It is not a sudden event, but the culmination of structural trends: declining inventories, rising industrial demand, increasing investment demand from buyers who prefer physical to paper, and a growing recognition among market participants that paper claims vastly exceed physical availability. The arbitrage that banks relied on has not just narrowed, it has inverted. The quantitative evidence of the arbitrage inversion is visible across multiple data points that collectively demonstrate banks face unprecedented costs and constraints in maintaining short positions. Silver lease rates, the cost of borrowing physical metal for a specified period, are the most direct indicator. Under normal conditions, lease rates for silver average 0.5 to 1.5% annually. These low rates reflect abundant supply and limited demand for borrowing. Banks can lease metal cheaply, sell it, and invest the proceeds at higher rates, earning the spread. Since mid-2024, lease rates have been persistently elevated. One-month lease rates have averaged 4 to 6% and have spiked above 12% during periods of acute demand. One-year lease rates, which historically stayed below 2%, now exceed 8%. These elevated rates mean that banks borrowing silver to maintain short positions must pay substantially more than they could earn investing the proceeds in risk-free assets like treasury bills, which yield approximately 4.5%. The inversion is stark. Borrowing silver costs 8 to 12%, while investing the proceeds safely yields 4.5%. This is a negative carry trade. The cost of borrowing exceeds the return on investing. Banks engaged in this trade are losing money continuously unless silver prices fall enough to offset the negative carry. But prices have not fallen. Silver has risen from approximately $18 per ounce in early 2020 to over $25 in late 2025. COMEX data shows the concentration of short positions. The Commitment of Traders, COT report, published weekly by the CFTC, breaks down futures positions by category. The commercial category, which includes banks and large traders hedging physical positions, has held net short positions exceeding 300 million ounces consistently for years. As of late 2025, the net commercial short position stands at approximately 280 million ounces. This 280 million ounce short position represents approximately 1/3 of annual global mine production. If the shorts needed to cover by buying futures or taking delivery, the market impact would be enormous. But covering is precisely what banks cannot do without driving prices higher. They are trapped in positions that generate losses if they maintain them due to negative carry and rising prices, and generate larger losses if they cover due to the price impact of buying 280 million ounces. Registered COMEX inventories, metal available for delivery, have fallen from 350 million ounces in early 2020 to 35 million ounces in late 2025. This 90% drawdown means that even if banks wanted to cover shorts by taking delivery of physical metal, there is insufficient inventory to do so at scale. Attempting to take delivery of even 10% of the short position, 28 million ounces, would nearly deplete registered inventories entirely. Delivery data confirms the stress. In 2020, total COMEX silver deliveries were approximately 30 million ounces. In 2022-24, deliveries exceeded 120 million ounces. In 2025 through November, deliveries have surpassed 150 million ounces, with December pending. This surge in deliveries is draining inventories faster than they can be replenished. Each delivery reduces the buffer available for future deliveries, tightening the market further. London Vault data shows parallel depletion. LBMA member vaults held over 35,000 metric tons of silver in early 2020. By late 2025, holdings have fallen to approximately 28,000 metric tons, a decline of 7,000 metric tons, 225 million ounces. This metal has primarily flowed to Asia, where demand for physical silver exceeds local mine production. The silver lease market structure reveals the depth of the problem. Leases are typically rolled over at maturity rather than settled through return of metal. A bank that borrowed 10 million ounces a year ago and sold it does not buy back 10 million ounces when the lease matures. Instead, it negotiates a new lease with the metal holder, or a different holder, and continues the short position. This rollover process works smoothly when lease rates are stable and metal is abundant. But when lease rates surge from 1% to 12%, and when holders of physical metal are increasingly reluctant to lend, rollovers become difficult and expensive. Banks must either pay exorbitant rates to maintain positions or cover by purchasing physical metal at spot prices. Neither option is attractive when spot prices are elevated and rising. The backwardation structure, where spot prices exceed futures prices, directly contradicts the logic of the lease and sell arbitrage. Normally, futures prices exceed spot by an amount reflecting storage and financing costs, contango. In contango, a bank can borrow metal, sell at spot, invest the proceeds, and buy back futures at lower prices, earning both the interest differential and the contango premium. But in backwardation, futures prices are below spot prices. A bank borrowing metal at high lease rates and selling at spot cannot buy back cheaper futures, because futures are priced below spot. The bank must either buy spot at elevated prices, incurring immediate losses, or maintain the short position and pay escalating lease rates indefinitely. The backwardation, which has persisted for over 90 days in late 2025, has eliminated the profitable arbitrage entirely. The magnitude of the backwardation is significant. These are not hypothetical calculations. They are the actual costs facing banks with substantial short positions in current market conditions. The losses are real, ongoing, and accelerating. The only exit strategy is to cover shorts by buying physical metal or futures. But covering drives prices higher, triggering larger mark-to-market losses on remaining positions. This is the classic short squeeze dynamic. The act of covering validates the price rise that forces covering. Industrial demand continues growing structurally, removing supply from the market permanently. Solar panel production consumed approximately 240 million ounces in 2025 and is projected to exceed 280 million ounces in 2026. Electric vehicle production used 90 million ounces in 2025 and is projected to reach 110 million ounces in 2026. Combined industrial demand for 2025 is estimated at 880 million ounces, exceeding mine production of 830 million ounces by 50 million ounces. This 50 million ounce annual deficit must be filled by recycling or inventory drawdowns. Recycling provided approximately 175 million ounces in 2025, primarily from electronics and industrial scrap. But even with recycling, the market runs a deficit of approximately 50 million ounces annually that must come from above-ground inventories. At this rate, visible inventories, COMEX and London combined, will approach zero within 24 to 36 months. Exchange-traded funds add another dimension. Global silver ETFs hold approximately 450 million ounces as of late 2025. These holdings are theoretically backed by physical metal in vaults, but the metal is not available to the broader market. It is segregated for ETF shareholders. If ETF inflows surge due to investor demand for physical exposure, funds must purchase additional metal from the spot market, competing with industrial users and further tightening supply. The concentration of short positions among a small number of banks creates systemic risk. Data suggests that 4 to 5 large banks hold the majority of the 280 million ounce net commercial short position. If one bank faces losses that force covering, the resulting price spike would trigger losses for other short holders, potentially creating a cascade where multiple banks scramble to cover simultaneously. This scenario, a coordinated short squeeze affecting multiple systemically important financial institutions, would likely trigger regulatory intervention or exchange rule changes. But such intervention would destroy confidence in paper silver markets and accelerate the bifurcation between paper and physical pricing. The silver lease rate surge, backwardation persistence, and inventory depletion are not isolated market anomalies. They are signals of a broader structural breakdown in the relationship between paper claims and physical commodities. A breakdown with precedents in monetary history and implications extending far beyond silver. The first signal is the failure of arbitrage as a price-correcting mechanism. Arbitrage is supposed to be risk-free or near risk-free profit from price discrepancies. When London spot silver trades at $25.80 and 3-month futures trade at $24.10, the 170 spread should be arbitraged away by traders buying cheap futures and selling expensive spot. This activity should continue until prices converge. The persistence of the spread indicates arbitrage is not functioning. The reason is that taking delivery on futures, converting paper to physical, has become uncertain, slow, or expensive. Traders cannot reliably buy futures at $24.10 and immediately take delivery to sell at $25.80 because delivery takes weeks or months, and by the time metal arrives, spot prices may have moved. The theoretical arbitrage exists on paper but cannot be executed in practice with acceptable risk. This breakdown reveals that futures markets are no longer credibly tethered to physical markets. Futures prices reflect paper market dynamics, speculative positioning, hedge fund strategies, bank derivative exposures. Spot prices reflect physical supply and demand, industrial needs, investment demand, inventory availability. When these diverge persistently, it signals that one market is mispricing reality. Given that spot requires physical delivery while futures allow cash settlement, the spot market is more likely to reflect actual scarcity. The second signal is the behavior of metal holders. Elevated lease rates indicate that owners of physical silver are increasingly reluctant to lend it. In normal markets, metal holders are happy to earn 1 to 2% annually lending metal they are not currently using. But at 12% lease rates, many holders still refuse to lend, suggesting they anticipate even higher rates in the future. Or they fear the metal will not be returned when the lease matures, or they view physical possession as strategically valuable beyond lease income. This hoarding behavior is characteristic of markets approaching shortage. When participants prioritize holding physical assets over earning income from lending them, it signals expectations of scarcity or systemic stress. The same pattern occurred in gold markets during the 1968 gold pool collapse. Gold holders refused to lend at any rate because they anticipated the system would break and metal would not be returned. The third signal is visible in the correlation breakdown between silver and other financial assets. Historically, silver has shown strong positive correlation with risk assets like equities. When stocks rise, silver tends to rise as a risk on trade. But since mid-2024, this correlation has weakened significantly. Silver has risen during periods when equities have fallen and has shown resilience during equity market volatility. This suggests silver is being bought for reasons independent of general risk appetite, specifically as insurance against systemic financial stress or currency debasement. The fourth signal appears in the behavior of miners. Silver mining companies typically hedge future production by selling forward contracts, locking in prices to reduce revenue volatility. But many miners have reduced or eliminated hedging since 2024, choosing to remain unhedged despite price volatility. This behavior indicates that miners, who have superior information about production costs and supply conditions, believe current prices significantly undervalue silver and expect substantially higher prices in the future. Miners are essentially betting their corporate viability on rising prices by refusing to lock in current levels. The fifth signal is the increasing divergence between COMEX prices and physical retail premiums. Retail silver coins and bars trade at premiums of 20 to 35% over COMEX spot prices in many markets. A silver eagle coin with 1 ounce of silver content might cost $32 when COMEX spot is $25. This 7 premium, 28%, reflects not just minting and distribution costs, which typically account for 5 to 10%, but genuine scarcity at the retail level. Physical buyers are willing to pay large premiums over paper prices because they doubt they can obtain physical metal at paper prices when needed. These cascading premiums, retail over spot, spot over futures, allocated over unallocated, Shanghai over COMEX, all point in the same direction. Physical possession is being valued substantially more than paper claims across all market segments. The hierarchy of trust is visible in the pricing structure. The least trusted instruments, COMEX futures, trade at discounts. The most trusted instruments, retail coins in hand, trade at premiums. The market is pricing counterparty risk and delivery uncertainty. The sixth signal is the public behavior of central banks toward gold, which provides context for understanding silver dynamics. Central banks have been net buyers of gold for 15 consecutive years through 2025. Total official sector gold purchases exceeded 1,000 metric tons in both 2022 and 2023, the highest annual level since the 1950s. China, Russia, India, Turkey, Poland, and other nations have aggressively accumulated gold reserves. This accumulation is occurring while these same central banks manage fiat currency systems and publicly maintain that gold has no monetary role. The contradiction signals that central bankers privately understand the fragility of pure fiat systems and are accumulating hard assets as insurance. If this logic applies to gold, it applies with equal force to silver, particularly given silver's industrial indispensability alongside monetary history. The seventh signal is the emergence of alternative pricing mechanisms. Shanghai Gold Exchange, silver prices, which require physical settlement, consistently trade at premiums of 12 to 15% over COMEX futures. The persistence of this premium for over a year, far longer than normal arbitrage windows, indicates that two separate markets are forming, a Western paper market and an Eastern physical market. The premium reflects not temporary supply disruptions, but structural preference for physical settlement over paper promises. All of these signals converge on a single conclusion. The silver market is transitioning from a system where paper claims were accepted as equivalent to physical metal to a system where physical possession carries substantial premiums, and paper claims are increasingly viewed as unreliable. This transition is not orderly or official. It is messy, occurring through market stress and price dislocations. But the direction is unmistakable. And for banks that have built business models on the equivalence of paper and physical, this transition is existential. History provides clear precedent for what occurs when arbitrage that major financial institutions depend upon inverts against them, trapping them in positions they cannot exit without triggering the precise outcomes they were betting against. The Hunt brothers' silver squeeze in 1979-1980 demonstrated the dynamics at smaller scale. As the Hunts accumulated physical silver in long futures positions, short sellers, primarily commercial traders and banks, faced mounting losses. Silver rose from $6 to over $50 in 18 months. Short sellers could not cover without driving prices higher, validating the squeeze. The situation was resolved through COMEX rule changes that prevented new long positions and forced liquidation through increased margins. But this solution was possible only because the longs were concentrated in identifiable parties who could be targeted. Current conditions differ in critical ways. The physical demand comes from industrial users who need silver for production, from Asian buyers who want metal for reserves or investment, and from Western investors who distrust paper claims. None of these groups can be targeted by exchange rule changes. COMEX cannot prevent solar manufacturers from demanding delivery. It cannot stop Chinese buyers from sourcing metal through Shanghai. It cannot eliminate investor preference for physical over paper. This means the traditional escape mechanism, rule changes to prevent delivery and force cash settlement, is unavailable or far less effective. If COMEX were to declare force majeure and settle contracts in cash, it would destroy confidence in futures as mechanisms for physical price discovery. Industrial hedgers would abandon the exchange. Physical markets would bifurcate permanently from paper markets. COMEX would become irrelevant to actual silver pricing. For banks trapped in short positions, the consequences are increasingly severe. Every day that lease rates remain above 8% and backwardation persists, banks incur losses. A bank short 50 million ounces faces costs exceeding $10 million per quarter just to maintain the position before accounting for any mark-to-market losses if spot prices rise further. Over a year, the costs exceed $40 million on a single position. These losses are manageable for large banks with diversified revenues, but they are real and escalating. If silver prices rise from 25 to 35, a 40% increase that would merely match the 2011 peak inflation adjusted, a bank short 50 million ounces would incur mark-to-market losses of 500 million. Such losses would be material even for systemically important banks, triggering risk management responses and potentially regulatory scrutiny. The bank's dilemma is that all exit strategies have negative consequences. Covering shorts by buying physical metal drives prices higher, inflicting losses. Covering by buying futures drives futures prices higher, narrowing or eliminating backwardation temporarily, but requiring even more expensive physical metal if delivery is ultimately demanded. Maintaining shorts indefinitely means bleeding costs continuously while prices potentially rise further. Defaulting on lease obligations or delivery commitments destroys reputation and invites legal and regulatory consequences. This is what no way out means in practice. Not that banks will necessarily fail. Large banks have deep resources and access to central bank liquidity if needed, but that the strategy they employed profitably for decades has become a trap, and exiting the trap requires accepting losses that invalidate the strategy itself. For the broader financial system, the implications extend beyond bank profit and loss. If major banks face large losses on commodity derivative positions, it raises questions about what other derivatives might be mispriced or concentrated in ways that create systemic risk. Silver is a relatively small market. Total annual production is approximately $20 billion at current prices. If banks cannot manage risk in a market this size, how confident should regulators and counterparties be in their management of far larger interest rate, currency, or credit derivatives portfolios? The credibility of commodity futures markets is also at stake. COMEX, LBMA, and other commodity exchanges function because participants trust that contracts represent genuine claims on physical commodities and that delivery will occur when demanded. If silver demonstrates that paper claims vastly exceed physical availability and that exchanges cannot or will not enforce delivery, trust in the entire commodity futures complex erodes. This erosion would affect energy markets, agricultural markets, and base metals markets. Industrial users that rely on futures for hedging would seek alternative arrangements, bilateral contracts with miners, physical inventory holdings, vertical integration. These alternatives are less efficient than liquid exchange-traded markets, but they provide certainty of supply that paper contracts increasingly do not. For investors, the silver situation provides a case study in counterparty risk and the difference between legal claims and physical possession. Investors holding unallocated silver in bank accounts have legal claims to metal, but if banks cannot source physical silver to honor allocation requests, those claims become contingent on cash settlement at prices that may not reflect physical market values. Investors who demanded allocated or took delivery of physical metal years ago now hold assets trading at substantial premiums over paper claims. The lesson is generalizable beyond silver. In any market where paper claims vastly exceed physical backing, whether commodity derivatives, gold ETFs not fully allocated, or even fiat currencies relative to goods and services, there is latent risk that a shift in preference from paper to physical will reveal inadequate backing. The shift may be triggered by financial stress, inflation fears, geopolitical events, or simply recognition that paper and physical are not equivalent. Governments may respond to a silver squeeze through various interventions. Export restrictions to retain domestic supply are possible. China could limit silver exports if domestic industries face shortages. Strategic stockpile releases are unlikely because most governments depleted silver reserves decades ago. Price controls or allocation systems are theoretically possible, but would create black markets and inefficiencies. The most likely intervention would be regulatory pressure on banks to cover short positions in an orderly manner, possibly with central bank liquidity support to prevent disorderly markets. But orderly covering still means buying metal, which drives prices higher. Central bank intervention can prevent bank failures, but cannot create physical silver that does not exist. Historical precedent suggests that when arbitrage traps major financial institutions, resolution comes through some combination of large losses for trapped participants, regulatory intervention to prevent systemic spillovers, and ultimately repricing to levels that reflect physical reality rather than paper promises. The 1968 gold pool collapsed, and gold repriced from $35 to $850 over the following decade. The Hunt episode ended in forced liquidation and rule changes, but silver still traded above $10 for years afterward, well above pre-squeeze levels. The current silver situation contains elements of both precedents, but with structural differences that may prevent clean resolution. The demand is more dispersed and less speculative. Industrial use is growing structurally. Asian accumulation reflects long-term preference shifts, and Western investment demand reflects monetary concerns. None of these can be eliminated through margin increases or position limits. The only resolution is through price rising to levels that curtail demand or stimulate supply sufficiently to balance the mark. In 1968, the London Gold Pool discovered that selling reserves to suppress prices eventually depletes those reserves, at which point the suppression ends and repricing begins. The strategy worked until it didn't, and when it failed completely. Today, banks that have shorted silver, borrowing metal to sell, betting on stable or declining prices, profiting from lease rate spreads, and price movements, face the inversion of the arbitrage they depended upon. Lease rates now exceed safe investment yields by substantial margins. Spot prices exceed futures prices, eliminating cash and carry arbitrage. Inventories have depleted to levels where covering large positions through delivery is practically impossible. The cost to maintain short positions is escalating, and the cost to exit them is even higher. This is not a temporary dislocation that will self-correct through normal arbitrage. It is a structural breakdown where the assumptions underpinning decades of profitable trading, abundant physical supply, low lease rates, contango price structures, have inverted. Banks are trapped in positions that generate losses if maintained and larger losses if covered. The broader signal extends beyond banks' profit and loss. It reveals that markets can function smoothly for years while accumulating imbalances, and then reach points where those imbalances cannot be unwound without triggering the precise outcomes that participants were betting against. Banks shorted silver expecting stable prices, and the act of shorting contributed to price suppression that encouraged demand exceeding supply. Now demand has grown to levels where covering shorts would drive prices sharply higher, validating the price rise the shorts were designed to prevent. This dynamic, where the strategy to prevent an outcome becomes the mechanism that ensures it, is not unique to silver. It appears in sovereign debt markets where central banks suppress yields until debt burdens become unsustainable. It appears in currency markets where intervention to prevent depreciation depletes reserves until intervention fails and depreciation accelerates. It appears whenever authorities or institutions attempt to control prices that reflect underlying supply-demand imbalances rather than addressing the imbalances themselves. The mathematics of the current silver market are clear. Lease rates at 12%, backwardation at 6.6% annualized, inventories down 90%, and industrial demand exceeding mine production by 50 million ounces annually. These numbers describe a market in transition from paper price dominance to physical price dominance. The transition is not complete, but the direction is established. For the banks, there is no way out that does not involve recognizing losses or triggering price increases that inflict losses. For the market, there is no way to restore equilibrium without prices rising to levels that curtail demand or stimulate supply. For the system, there is no way to maintain the illusion that paper claims and physical metal are equivalent when lease rates, backwardation, and premiums all signal they are not. History shows these transitions are not smooth. They occur through crisis, default, repricing, or intervention. Which outcome occurs in silver remains uncertain in timing and specifics, but that one will occur is increasingly certain. The arbitrage has turned against the banks. An arbitrage, once inverted, does not reverse until the positions that created it are eliminated.